Well, we're just moments away from the Fed statement on interest rates and the state of our economy. So let's bring in our panel of Fed experts. Joining me now, Keith Springer, president of Springer Financial Advisors, Marvin Goodfriend, professor of economics at Carnegie Mellon University, and former senior vice president and policy advisor at the Richmond Federal Reserve, Phil Flynn. He's joining us from the pit at the CME. And still with us is Nicole Pedalides. She's on the floor of the New York Stock Exchange. Keith, I want to start with you. In a note, you said that you suggested the only thing that could save the stock market is a rescue by the Federal Reserve. How is that?
Well, you can see that the market is addicted to the stimulus. It has been for the entire rally for the last couple of years. I don't believe there's any aggregate demand in the economy. We've got a lot of headwinds. You've got an aging population. You've got an over-indebted population. There's just no place for it to go. It's much like I wrote about in my book, Facing Goliath. There's no aggregate demand, so the government is trying to create through stimulus. And I think the economy is addicted to the stimulus. And I think anything less than some form of action by the Fed today is going to cause a sell-off and a resumption of the big sell-off. And that's what I'm most fearful of right now.
Marvin.
Well, the Federal Reserve is about monetary policy. It's about price stability. That's its job one. The developments last week, however damaging they've been to the economy, they really have very little to do with monetary policy. There's plenty of liquidity, zero interest rates, the capacity to do a lot more. The last I looked, the monthly numbers on inflation, especially the core number, were rising slightly. The Fed is nervous about that. It's the job of the fiscal authorities to fix the economy. The Fed's major problem is being pressed into doing something prematurely, which has the potential to create more inflation than the Fed would like to see. So I think the Fed will be on hold for the time being.
Marvin, I thought it was the exact opposite. I thought the Fed, the only reason they hadn't moved was they were intimidated by deflation, and in fact their ultimate goal is inflation, which would include the stock market, but other assets that people are holding right now.
I think it's a misreading to say that the Fed was trying to inflate the economy. You're right about the fact that the QE2 was set up against a potential deflation. But I think the Fed is pretty happy with 1 to 2% inflation and inflation no higher.
Phil, we got to get to you quickly. What's going on down there at on the CME? Are these guys rooting for action from the Fed, or do they care one way or the other?
No, I think they do care, but I'll tell you what, this is historic because this is the first Fed meeting ever after a downgrade of the U.S. economy. So this is very important, how the Fed is going to react to this. It's kind of interesting. We had a 3-year note auction just a little while ago. It went very well. And what we see in the aftermath, a lot of central banks around the world were buying our debt. So they're getting ready to pump us up and give us a vote of confidence, which leads me to believe that they are very worried about how this meeting is going to play out. As far as what we're seeing on the yield curve, we're seeing a lot of buying come in on the long end of the yield curve. You know, those bonds were lower a little bit. They're buying those back up. That could be a sign a lot of people are getting a little bit worried that the Fed is going to do some type of quantitative easing. Now, all the talk right now is that the Fed's going to forget about the short end, focus on the long end, and that may be one of the reasons why we're seeing the buying on the long end right now. But a lot of traders right now are saying, and they were joking around before the meeting, the Fed's going to come out and say, we don't know what to do, raise their hands up, so they don't know. But I think that they're looking for confidence. Look, the market's looking for confidence. Look what's happening in the gold market. The VIX, over the last couple of days. Look what happened after the president spoke yesterday. There is fear in the market. There is nervousness. Now we're calming down a little bit. We're looking for the Fed to continue along, say the right things. What those things are, you can ask 4 or 5 guys back here. They'll give you a different answer. But right now, that's what the market is getting ready for.
Keith, does the Fed have any more bullets to use? It seems that it really has pulled all of its levers. It really is nothing to give that confidence that Phil was saying that the investors need, other than opening up the spigots and printing more money.
Well, that's probably what they're going to do, opening it up, the spigots in a sense, doing another asset purchase. I think that's what the market is looking for. You do have the law of diminishing returns, meaning you're not going to have the same positive effect, but I do think the market is looking for that. It's clear the way treasuries are reacting. It's not the downgrade that is so important. It's the slowing economy, not only domestic, but globally. That's why treasuries are going up and money is flowing in as a flight for confidence, as a flight for safety, and yields are dropping because of the overall economy slowing worldwide and domestically. And that's what the Fed is most worried about. With so little growth, they've got to create some form of aggregate demand. They've got to create some growth. That's why I think they have to come up with another type of QE program, and that's what the market is looking for. What the other guest failed to recognize is the emotional aspect of the market. It's one thing to look at it on paper, but the market is an emotional being, and people are very emotional with their money, and you've got to give the feeling and the impression that the Fed knows what they're doing.
Marvin, I think that might have been aimed at you. In other words, the Fed...
Not in a bad way.
Not in a bad way, but listen, here's the deal. Ben Bernanke came in. He was criticized for being behind the eight ball, if you will. Marvin, can the Fed, the Ben Bernanke Fed, really afford to wait for recession to come back?
No change. Economic conditions are likely to warrant exceptionally low levels for the federal funds rate at least through mid-2013. That's the policy change. Through 2013.